Gas prices are rising again, and this time, it's not just inflation, it's strategy. What just happened could hit your wallet within days. Donald Trump has just escalated tensions with Iran, and markets reacted instantly. Oil surged past $100, stocks dropped, investors pulled back. But here's the key shift. This wasn't just another warning. Trump made it clear, military operations will continue for weeks, with no clear end date. And that single signal changed everything. Because markets weren't expecting escalation, they were expecting an exit. Instead, what they got was uncertainty. Right now, global investors are moving into risk-off mode, pulling money out of stocks, bracing for prolonged conflict, and preparing for something much bigger, a sustained energy shock. Here's what you need to understand. This isn't just about war anymore. It's about oil, inflation, and how long this pressure lasts. And what happens next is the real story. This didn't start today, but today changed the direction. Tensions between the US and Iran have been building for weeks. Quiet deployments, strategic warnings, limited strikes. At first, markets treated it as controlled escalation, something contained, predictable. But that assumption just broke. Trump's latest statement confirmed what investors feared but didn't fully price in. This isn't a short operation. It's an open-ended pressure campaign. And we've seen this pattern before. Short-term military signals, followed by prolonged economic consequences. The difference now? Timing. Global markets are already fragile. High interest rates, sticky inflation, and slowing growth. So when oil suddenly spikes, it doesn't just affect energy, it amplifies everything else. And this is where things start to shift. Because Iran isn't just another geopolitical player, it sits near one of the most critical oil choke points in the world. Any signal of prolonged conflict immediately raises one question: will supply be disrupted next? And if that happens, the market reaction we're seeing now may only be the beginning. Here's what actually happened, step by step. Trump delivered a direct warning. Operations tied to Iran will continue, with no immediate off-ramp. That statement alone shifted expectations. Within hours, oil markets reacted. Prices jumped sharply as traders began pricing in a longer conflict window. Equities followed, pulling back as risk exposure suddenly looked misaligned. Capital started moving. Fast. Investors rotated out of growth assets and into safety, cash, bonds, and energy-linked positions. At the same time, shipping and insurance costs in the region began to rise, not because of confirmed disruption, but because of perceived risk. And that distinction matters, because markets don't wait for events to happen. They move on signals. But this is where the story changes. There's still no confirmed supply shock, no blocked routes, no direct hit to major oil infrastructure, yet prices are already climbing, which tells you something critical. This reaction isn't about what has happened, it's about what markets believe is coming next. This is no longer just a regional conflict, it's an economic pressure point, because the real leverage here isn't missiles, it's UNIFT, oil flow. Iran sits near the Strait of Hormuz, one of the most critical energy choke points on the planet. Roughly a fifth of global oil passes through this narrow corridor every single day. So when tensions rise here, markets don't wait for disruption, they price in the risk of disruption. And that's exactly what we're seeing now. But here's the deeper shift. This moment is exposing how fragile the global energy system still is. Even after years of diversification, one region can still move prices worldwide. And for the US, this isn't just about Iran. It's about controlling escalation without triggering a full-scale supply shock. A balancing act. Apply pressure, but avoid breaking the system. Because if oil flow is even partially disrupted, the consequences won't stay regional. They will transmit globally, through fuel, transport, food, and inflation. And that's where this situation becomes far more than a geopolitical standoff. It becomes an economic trigger. Here's what most people are missing. This isn't just escalation, it's calibrated pressure. Trump's move signals a strategy built on controlled uncertainty. Not full-scale war, not de-escalation, something in between. By keeping operations open-ended, the objective isn't immediate confrontation, it's sustained leverage. Pressure Iran economically, disrupt confidence, force reactions without crossing the line into total conflict. At the same time, this creates a second layer of impact on global markets. Because uncertainty itself becomes a tool. Higher oil prices weaken fragile economies. Market volatility shifts capital flows, and politically, rising fuel costs can reshape domestic pressure, both in the US and globally. But this strategy carries risk, because it relies on one assumption, that Iran absorbs the pressure without escalating further. And history suggests that assumption doesn't always hold. Iran's playbook often involves indirect response, proxy activity, regional signaling, asymmetric disruption, not immediate, but calculated. So what looks controlled on the surface may already be setting up the next phase underneath. But the other side tells a different story. From Iran's perspective, this isn't controlled pressure, it's deliberate escalation. And that distinction changes the response. Instead of backing down, Iran is more likely to reframe this as resistance. Not direct confrontation, but strategic pushback. That could mean activating regional proxies, increasing pressure in nearby shipping lanes, or signaling capability without crossing the threshold into open war. Because Iran doesn't need to shut down oil flow completely to create impact. It just needs to make the market believe it might, and that alone can keep prices elevated. At the same time, there's a diplomatic layer unfolding quietly. Back-channel signals, indirect warnings, attempts to contain the escalation without appearing weak. But this creates a dangerous gap. Both sides may believe they are acting below the threshold, while the overall system keeps moving closer to it. And that's where miscalculation becomes the real risk. Not intentional escalation, but escalation by reaction. This is where it becomes real for you. Higher oil prices don't stay in the headlines, they move directly into your daily life. Gas stations adjust first. If crude holds at elevated levels, fuel prices follow within days, sometimes faster. And it doesn't stop there. Transport costs rise, shipping becomes more expensive, businesses pass those costs forward. That means groceries, delivery, flights, everything starts to edge up again. And here's the problem. This comes at a time when inflation hasn't fully cooled. So instead of relief, this adds pressure back into the system. Central banks then face a new dilemma: cut rates to support growth or hold firm to fight rising prices. Either way, uncertainty increases. Markets feel it, jobs feel it, and consumers feel it the most. But this is where the deeper risk sits. If this tension holds, it doesn't just create a price spike, it resets expectations. People start preparing for higher costs ahead, and once that mindset locks in, inflation becomes harder to control. So what happens next? Right now, markets are pricing in prolonged tension, not immediate conflict. That's the baseline scenario. In the short term, expect continued volatility. Oil stays elevated, markets remain cautious, capital stays defensive. But the real turning point comes from one factor: reaction. If Iran responds indirectly, through regional pressure or shipping risk, oil could spike further, fast, not gradually, suddenly. And that would push this from a market adjustment into a full economic shock. On the other hand, if back-channel diplomacy stabilizes the situation, we could see a temporary cooling. Prices pull back, markets recover. But even then, the damage isn't fully reversed, because the signal has already been sent. This region is unstable again, and investors don't forget that quickly. Midterm, this sets up a new environment: higher baseline energy prices, persistent inflation pressure, and more reactive global markets. So here's the bottom line. This isn't a one-day headline. It's the beginning of a cycle. And the next move won't just shape geopolitics, it will shape what you pay, what you earn, and how stable the economy feels in the months ahead. If you want to stay ahead of these shifts, understand them before they hit, subscribe to GeoBrief.